I want you to picture a very specific, almost universally recognized scenario.
Okay, I think I know where you're going with this.
Right. It's late at night, the television is glowing, and, a commercial break starts, and suddenly you're looking at this familiar, nostalgic
Oh,
celebrity.
yeah, like an actor from an old 80s detective show or something.
Exactly. And they're walking through this warmly lit kitchen, looking right into the camera, and they lower their voice into this incredibly serious, comforting register and just start warning you about the dangers of living on a fixed income.
Which, I mean, that always culminates in the pitch for the reverse mortgage, right?
Always. Every single time.
Yeah, and it's a marketing trope that has basically, well, it's wired our collective psychology to view these financial products with intense suspicion.
Oh, absolutely.
The immediate association you make is that this is a product of desperation. Like, it's for people who have completely run out of retirement funds, or it's some predatory mechanism designed by a bank to quietly steal the family home while you aren't looking.
Yeah, that stigma is practically cemented into our culture. But what's wild is that for today's deep dive, we've been looking at some recent data and case studies.
Mm.
Specifically, there's this really fascinating breakdown from an Orlando-based loan officer named Peter Kilsheimer.
Right, and the math he presents, it completely shatters that late-night TV narrative.
It really does. I mean, we're talking about high net worth individuals, people who have zero financial desperation, who are quietly using reverse mortgages. They are doing it to buy groceries.
No, not at all. They are using it as a highly engineered, deeply strategic tax loophole and, well, a wealth preservation tool.
Which is just wild to think about. So the contract between the public perception and the private application of this tool by the wealthy is staggering. Today, we are going to completely deconstruct the actual financial architecture of these loans.
Yeah, we really need to look at how flipping the vector of traditional debt allows retirees to maintain total liquidity, plus how the tax code treats these specific funds.
And crucially, how sweeping regulatory changes effectively killed the predatory practices that originally gave the industry that toxic reputation.
Exactly. So let's jump straight into the psychology and the math of what Kilsheimer calls the retirement relocation dilemma.
Yes, this is happening constantly,
Yeah.
especially in high-growth states like Florida, which, I mean, it sees over 1,000 new residents arriving every single day.
Wow. Yeah, that's a lot of people moving.
Right. So let's say you live in a high cost of living market, like California, New York, or Minnesota. You've been paying down a mortgage for 30 years, the house is finally free and clear, and you decide to sell it and head south.
So you sell that property in California, and after closing costs, let's say you walk away with $800,000 in pure liquid cash sitting in your bank account.
A pretty great position to be in.
Oh, for sure. And you find a beautiful, newly built home in Central Florida for $600,000. Now, for generations, the ultimate American financial dream dictates your next move, right?
Right. You write a check for the $600,000, buy the Florida house in cash, and live out your days without ever thinking about a mortgage payment again.
Exactly. But, and this is where the dilemma comes in, doing that might actually be a massive mistake.
Okay, wait, I'm going to stop you right there. Because calling a fully paid off house a dilemma, or I think the notes actually called it a trap, that feels entirely backwards to me.
I know, it really goes against conventional wisdom.
Right, because if I pay cash, I own it free and clear. No bank can touch me, my monthly overhead plummets.
Yeah.
How on earth is having zero debt and a paid-off roof over my head a trap?
Well, because you are trading ultimate financial optionality for a piece of paper, the trap is liquidity. Or, rather, the sudden lack of it.
Okay, unpack that for me.
Sure. You have taken a highly liquid asset like cash that can be deployed instantly for investments, emergencies, experiences, and you have effectively entombed it in drywall and concrete.
No.
You are incredibly wealthy on paper, yes, but you have engineered a scenario where you are cash poor in your day-to-day reality. Ah, okay. So the friction is psychological just as much as it is financial.
Exactly.
If I dump all my liquid cash into the house, leaving me with maybe, what, $200,000 in the bank, I'm going to feel that scarcity.
You will. Every time you want to spend money.
Right. Suddenly, I'm second-guessing taking the grandkids on a 2-week cruise. I'm hesitating to invest in a new business venture. I'm lying awake worrying about a catastrophic medical bill. And not because I don't have the wealth, but because that wealth is basically trapped under the floorboards of my living room.
That's perfectly said. And the visual data we reviewed illustrates this beautifully. It shows this literal balance scale. By writing the all-cash check, all the weight shifts to illiquid home equity.
Right, the scale tips completely to one side.
Exactly. But the alternative is utilizing the reverse mortgage to purchase the new home. You put down a fraction of the cost, finance the rest, and retain hundreds of thousands of dollars in a liquid account.
The wealthy don't use this tool because they're broke. They use it because locking up cash in an illiquid asset that doesn't generate a yield is, well, mathematically inefficient.
It's kind of like, okay, imagine prepping for a massive wilderness expedition and choosing to lock all your state-of-the-art survival gear inside a heavy titanium safe that you drag behind you.
Huh, that's a great visual.
Right, like you technically own the world's best tent and the finest water purifier, but when a storm hits and you can't get the safe open, the fact that you, quote-unquote, own the gear is totally irrelevant. You have the asset, but you lack the utility.
A perfect distillation of the concept. Wealth only matters if it can be deployed when you actually need it.
Okay, so if the objective is to keep cash liquid, but we also want to avoid the burden of a heavy monthly mortgage payment draining our retirement accounts, we really need to talk about how this actually functions.
Yeah, the mechanics are key here.
Because with a traditional mortgage, you're fighting against amortization. You borrow cash, and every month you feed cash back into the house, slowly grinding the principal down to zero over 30 years.
Right. But the reverse mortgage completely flips the vector of the cash flow. Instead of you paying the lender monthly, the lender extends a pool of credit to you.
Okay.
You can take it as a lump sum or a line of credit that grows over time, or use it to cover the purchase of the home, like in our example. But the core mechanical difference, the absolute center of the strategy, is that you are never required to make a monthly mortgage payment.
But wait, the lender isn't running a charity, right? They are charging interest on that loan.
Of course they are.
So if I am intentionally refusing to write them a check every month, what exactly is happening to the math in the background?
This brings us to a concept called negative amortization. Because you are not servicing the interest every month, that unpaid interest doesn't just vanish. It accrues.
It piles up.
Exactly. It gets added to the principal balance of the loan. So month by month, year by year, the amount you owe the bank actively grows.
See, I have to push back hard on this. I understand keeping my cash liquid, but if I'm sitting in this house for 20 years and the loan balance is just compounding and ballooning in the background, am I not just constructing a giant ticking financial time bomb?
That's the exact fear everyone has.
I mean, when I pass away, aren't I just handing my kids a massive underwater debt that they have to scramble to pay off?
The fear of burdening the next generation is exactly what keeps people away from this tool. But the mechanics of the estate process are explicitly designed to insulate your heirs.
Really? How so?
First, we need to clear up a massive misconception. You never give up the title to the home. The bank does not own the house.
Okay, that's huge.
You own it, and it passes to your estate just like any other property.
So the title stays in my name. The bank is just a lien holder.
Correct. When you pass away, the debt does not magically jump onto your children's personal credit reports. The loan is attached entirely to the property itself.
Oh, I see.
And your estate is generally given up to 12 months to sell the house to satisfy the loan.
Okay, but let's play devil's advocate here. What if I live to be 100, right? The interest is compounded for 3 decades, and the loan balance is now, say, $900,000. But the housing market tanks, and the property is only worth $600,000.
A completely valid scenario.
So who is holding the bag for that $300,000 shortfall?
The Federal Housing Administration.
Wait, really? The FHA?
Yes, these are FHA-insured loans. They operate as non-recourse debt.
Non-recourse, okay, meaning...
Meaning that if the loan balance eventually exceeds the market value of the home, neither you nor your heirs are personally liable for the difference. The lender can only recover up to 95% of the appraised value of the home.
So they can't come after the estate?
No, they absolutely cannot come after your bank accounts, your stock portfolio, or your kids' assets to cover the spread.
But why on earth would a lender agree to a non-recourse structure? If they are guaranteed to take a loss in a housing downturn, the math just doesn't make sense for the bank.
Because the lenders aren't taking the risk. The insurance pool is taking the risk. When you take out a reverse mortgage, you pay an upfront mortgage insurance premium plus an annual premium that accrues. That money goes directly to the FHA to fund a massive insurance pool.
Okay, that makes so much sense now.
Yeah, so when a borrower lives a long time and the house goes underwater, the FHA taps that insurance pool to make the lender whole. You are paying for the very insurance that protects your kids from inheriting an underwater asset.
Wow.
Furthermore, historically, real estate appreciates. Most of the time, the estate sells the house, pays off the balloon balance, and the heirs still walk away with a check for the remaining equity anyway.
Okay, the mechanics of the non-recourse structure make total sense now. The risk is pooled, so preserving liquid cash is great, shielding the heirs is great, but here's the absolute wildest part of the source material.
The tax strategy.
Yes, the loan officer, Kilsheimer, explains that the actual holy grail for wealthy retirees isn't just about cash flow. It's a maneuver that happens entirely on their tax returns.
This is the mechanism that transforms the reverse mortgage from a simple housing loan into a highly engineered wealth preservation loophole.
Well, I need this explained perfectly because standard tax logic dictates that deductions come from spending money. Like, if I run a business and buy equipment, I write off the expense.
Right, that's how it normally works.
So, if I am intentionally not making mortgage payments on this house, how am I generating a tax deduction?
It requires a strategic understanding of how the IRS classifies different types of capital. Let's break it down into two phases.
Okay, phase one.
Phase one is accessing the capital. Any money you pull from a reverse mortgage, whether it's a lump sum or drawn from a line of credit over time, is classified as loan proceeds.
Got it.
It is borrowed money, not earned income. Therefore, it is 100% tax-free. You can pull $100,000 out to live on, and it doesn't bump your taxable income up a single cent.
That makes perfect sense. A loan isn't income, so the IRS can't tax it.
Exactly. Now, phase two is where the arbitrage happens. Remember the negative amortization, the interest that is accruing on the loan every month because you aren't paying it.
Yes, the ballooning balance we talked about.
Well, under the tax code, mortgage interest is deductible. But, and this is the critical catch, it is only deductible in the year that you actually pay it.
Ah, so because I have the option to not pay it, it just sits there building up.
Yes. It acts like a massive stored-up battery of tax deductions.
Oh, wow.
Let's say you are a high-net-worth individual. For 5 years, you let the interest accrue on your reverse mortgage. You haven't paid a dime. Then, in year 6, you have a massive liquidity event.
Like selling a business or something.
Exactly. Maybe you sell a secondary property or you execute a massive Roth IRA conversion. That generates a huge tax liability that would normally push you into the highest possible tax bracket.
Oh, I see exactly where this is going.
Right. In that specific year, you take some of your liquid cash and you voluntarily make a massive lump sum payment against the accrued interest on your reverse mortgage.
So you unleash the battery.
You unleash the battery. Because you paid all that accumulated interest in one calendar year, you trigger a colossal mortgage interest deduction exactly when you need it most. You artificially suppress your taxable income, potentially dropping yourself into a much lower tax bracket.
That is just brilliant. It's entirely a timing mechanism. You are avoiding the interest. You are basically hoarding the deduction until the exact moment it provides the maximum financial shield for your wealth.
Exactly.
As Kilsheimer pointed out in the data, the sheer volume of tax savings generated by perfectly timing that deduction, it can literally fund an annual family cruise out of Port Canaveral.
Yeah, the savings are that significant.
You are paying for your lifestyle using the money you legally sheltered from the IRS.
When you view it through that lens, you realize it is a product built for people who want to ruthlessly optimize their balance sheets.
But, okay, this brings up a glaring contradiction for me. If this financial architecture is so mathematically elegant and so heavily utilized by the wealthy, why is the reputation so deeply toxic?
That is a very fair question.
Why do we still have this visceral reaction that it's a scam?
Because for a long time, the industry was hiding a devastating systemic flaw. The reputational damage wasn't just some misunderstanding. It was earned through actual widespread predatory practices.
Really? Like what?
Well, this peaked around the 2008 financial crisis and continued until major regulatory intervention in 2013. It all came down to actuarial math and married couples.
Actuarial math.
Okay.
See, the amount of money you can access in a reverse mortgage is heavily based on your age. The older you are, the shorter your life expectancy, meaning the more money the bank is willing to lend against the house.
Makes sense. But what happens if a 75-year-old husband applies for a loan, but his wife is only 60?
Well, the younger wife drags down the actuarial math,
Yeah.
right? So they wouldn't qualify for as much money.
Precisely. So, major financial institutions, and we're not just talking about shady back alley lenders, but massive banks, would tell the couple, hey, we can get you a much larger payout, but we have a technicality.
Uh-oh. I don't like the sound of that.
Right. They'd say, we need to remove the 60-year-old wife from the deed of the home to originate the loan based solely on the husband's age.
That sounds like a catastrophic red flag.
It was a ticking time bomb. The couples, trusting the banking institution, would agree. They would get a larger payout and everything would seem fine. But then the older husband would pass away.
Oh, no.
Ah.
It's a literal bait and switch. You sign the paperwork thinking you're securing a comfortable retirement, and the bank is just quietly waiting for your spouse to pass away so they can spring the trap.
That is exactly what happened. Because the husband was the sole borrower and the only one on the deed, his death triggered the loan to become immediately due and payable.
But what about the widow?
The grieving 60-year-old widow, who the bank had convinced to sign away her ownership rights, was no longer legally recognized as an owner. The bank would foreclose, and the widow would be evicted from her own home.
That is genuinely horrific. They weaponize the actuarial tables to strip equity from surviving spouses. I mean, if an industry was capable of engineering that, why should anyone trust the modern iteration of this product?
Because the Department of Housing and Urban Development HUD and the FHA brought the regulatory hammer down hard in 2013 and 2014, they eliminated that exact mechanism.
So that closed the loophole.
The modern safeguards didn't just tweak the rules, they fundamentally re-engineered the safety of the product. Today, a lender is strictly forbidden from requiring a spouse to be removed from the title.
Okay, so the non-borrowing spouse is legally shielded now.
Completely. The rules now state that if one spouse qualifies, the younger, non-borrowing spouse can remain on the deed. If the older borrowing spouse passes away, the surviving spouse is granted a deferral period.
Meaning they don't get kicked out.
Exactly. They are legally allowed to remain in the home for the rest of their natural life without making a mortgage payment as long as they keep paying the taxes and insurance. The eviction loophole is dead.
Okay, that is a massive
Yeah.
structural fix.
Mhm.
Are there other safeguards? Like, what's preventing borrowers from just blowing through all their equity in year one and ending up destitute?
The entire loan-to-value structure has been age-scaled to prevent exactly that. Let's return to our relocation scenario from earlier.
The Florida house.
Yeah. If you are 62 years old, which is the youngest qualifying age, you mathematically have decades of life ahead of you. The FHA rules dictate that you cannot access all the equity. The system might require a 62-year-old to put down a massive 60% down payment when purchasing a home with a reverse mortgage.
Ah, meaning they have to leave a massive safety cushion of their own cash in the property
Right.
just to ensure the compounding interest has room to grow without immediately swallowing the whole asset.
Correct. But as you get older, the actuarial risk decreases. If you execute the strategy at 85 years old, your life expectancy is much shorter.
Right.
The mathematical probability of the loan balance outgrowing the home's value is minimal. Therefore, the regulations loosen, and an 85-year-old might only be required to put down 10 to 15%.
Wow.
The system is now heavily regulated to prioritize the borrower's long-term housing stability over the lender's immediate loan volume.
It really is a profound shift. You take an unregulated environment that incentivizes predatory behavior, you introduce strict math-based guardrails, and suddenly the product evolves into a protective wealth management tool,
Exactly.
which really forces us to look at the broader picture here. Deciding how to finance housing in retirement is not just a real estate transaction. It is the cornerstone of your entire estate and lifestyle planning.
The lunch conversation you referenced earlier with Kilsheimer, it captured this mindset shift perfectly. We are socially conditioned to believe that the ultimate victory in life is holding the deed to a free and clear house. Pay off the mortgage at all costs.
Right, that's the dream we're all sold.
But the strategic use of a reverse mortgage asks a much more difficult, much more valuable question. How can I leverage the equity I spent decades building to actually fund the lifestyle I want to live right now?
That leads to a philosophical debate about legacy that, honestly, it blew my mind when I was reading through the source materials. We have an entire generation of retirees who are living artificially constrained lives.
Oh, completely.
They are clipping coupons, denying themselves travel, stressing over utility bills, and just hoarding their liquidity, all to achieve one ultimate goal, leaving a massive $1 million paid-off house to their children.
And the devastating irony, as the data points out, is what happens the exact moment those children inherit that pristine, paid-off house.
They sell it immediately. They don't move their families into it. They have their own careers, their own school districts, their own lives across the country. They call a realtor, they liquidate the house, and they take the cash.
The parents endured decades of artificial scarcity just so the kids could receive a slightly larger wire transfer after they are gone.
Which leaves you with this deeply provocative question to mull over.
Yeah.
What is the actual purpose of the wealth you've built?
That's the real question.
Would you rather live a constrained, financially stressed life just to leave a slightly bigger inheritance check to your kids? Or would you rather utilize a tool like a well-structured reverse mortgage to unlock that illiquid equity today?
I know which one I'd choose.
Right. You could preserve your cash flow, optimize your tax brackets, and use that money to take your kids and grandkids on that vacation this year. You could use the wealth to create shared, lasting memories with them while you're actually still here to enjoy it.
It really is the fundamental difference between leaving a legacy of transferred wealth and living a legacy of shared experiences.
So the next time you are awake at 2 in the morning and you see that nostalgic television detective pacing around a kitchen offering financial advice, you don't need to just roll your eyes and assume it's a scam.
Definitely not.
You might just want to look at your own balance sheet and ask yourself, is your hard-earned wealth locked away in a heavy titanium safe where it can't help you? Or is that here in fluid, optimized, and actually working to build a life you want?